the true story is actually not being told. I don't think people know the actually nitty gritty details of actually what happened on Wall Street Bets to set this powder keg off. What's cool about this is since I'm in Wall Street Bets, I can go back in the history and I can see what actually happened. So without further ado, we're going to talk about what happened on GameStop these past 2 weeks. And number two, we're going to talk about the Holy Grail, the source, the soul, the summit, the Holy Grail of investing, which is risk management. Because you can actually be a really crappy trader. You can only win 1/4 of the time and still turn a profit. We're going to talk about how to do that, like especially how to be beginner friendly with your risk management so that you can stay alive. Capital preservation is the most important part of this game. And people say that like as a mantra, like, oh yeah, capital preservation is the priority. And the reason why we're going to go into that in this presentation, the reason why is because losing hurts you more than winning actually helps you. For example, say you've got $1,000 and you lose 50% of your account. You go from $1,000 to $500. To go back to $1,000, you have to get a 100% gain. Or did I say $50 and 1,000? 50 and 100, right? 100 to 50. To go from 50 to 100, you have to get a 100% gain. So if you lost 50%, to make that back, that $50 has to work double time. It has to make all of itself back to go back to 100. Because of the laws of mathematics, this is the reason why risk management is the most important part of this game, cutting your losses. The standard way that people approach the markets, like the standard human psychology, is to hold our losses, to hold losing stocks, and to sell winners. To be a winner, you have to flip the script. You want to be cutting losses, you want to be cutting your losing stocks with impunity, and you want to be holding on to your winners and letting them run. As they say in on Disney Plus in The Mandalorian, this is the way. So without further ado, let's talk about GameStop. What the heck happened this past 2 weeks? How does a stock go from $4 a year ago to touching $500 this morning? So let's set the stage, right? Let's go back in time. 6 years ago, I'm looking at the total revenue. This is the total revenue numbers for GameStop. Back in fiscal year 2014, they were making $9 billion a year, and they've been steadily downtrending since then. So they made $6 billion last year, almost 50% what they made 6 years ago. So with that being said, the death of GameStop is the result of gamers are actually downloading their games online now, pretty much. So they're not going into retail stores to buy their games. So you got that, plus the coronavirus pandemic, where that was the death of retail in general. So you have this double whammy scenario where Wall Street is betting against this stock, because how can a situation where people are buying them online already without the pandemic, and then you have the pandemic who is discouraging, which is discouraging people to go to retail stores. This is setting up a situation where, hey, I want to bet against this stock. Well, the way you make money in a standard way in the stock market is, of course, we all know this, right? Buy low, sell high. I buy a stock at $5 and I sell it at $20. I make 4 times my money. That's the normal way. We call this going long in the stock market. When you say I'm going long, that means I'm expecting it to go from low to high. But there are exactly two ways to make money in the stock market. There's another way. You can actually sell high and buy low, which is crazy. How can you sell something you don't own? We call this shorting. And I'm going to go through an example that's really popular on Twitter and on Reddit of how the heck can you sell something you don't own, buy it later, and make money? It doesn't make sense. It doesn't intuitively make sense. So let's make it make sense. So there's a gorilla, and he's got 5 bananas that are worth $10. He's got a friend who's a snake. So the snake sees the bananas that are worth $10, and he says, dude, those are clearly overpriced bananas. I'm jumping the gun. I want to bet that that buying 5 bananas is going to go from $10 to $2. There's no way that, like, bananas are overpriced at $10. And so the snake, he goes to the gorilla and he says, hey, let me borrow your 5 bananas. I'm going to pay you interest for borrowing your bananas, and I'm going to give them back to you in a few weeks. So the gorilla's like, okay, cool. Like, I'm still going to get my bananas back. So he hands the bananas over to the snake, and the snake now has 5 bananas that he can do whatever he wants with. So now so this is what's called borrowing, of course. So now this snake can sell all of the bananas at $10. So this is what the snake is trying to do. How shorts make money in the markets. The snake borrows those 5 bananas at $10, and then he waits, tries to buy them back at $2. So that means he made an $8 profit because he sold them at $10. The gorilla has 5 bananas. The snake goes to the gorilla, grabs the bananas, takes the bananas, sells them at the market for $10, and then waits, right? So that's what he's paying interest to the gorilla for, because now the gorilla doesn't have his bananas. So time goes on, the price of the bananas dropped to $2. The snake goes to the market, buys them for $2. So the snake already has $10, spent $2 of that to go buy the bananas, gives the bananas back to the gorilla, and guess what? The snake made 5 times his money. Well, that's how shorting works. You borrow it, and then when you end a short position, you have to what's called cover your position. You have to cover your short. So if this is what shorting is, what happens in a short squeeze? So say on the day that the snake goes to the gorilla to borrow those bananas, there was a viral YouTube video where a famous chef came up with this amazing banana pudding recipe, and the video went viral. And all the gorillas are like, holy crap, I want to make this banana pudding recipe. So the snake, on that same day, he sold the bananas at $10, but the market went into a frenzy. Everybody wants to make this banana pudding recipe. So the gorillas are just buying bananas. We're going to make this banana pudding recipe. So everybody's buying and buying and buying bananas. And guess what? By the laws of supply, I see you, Wesley. By the laws of supply and demand, the banana price must go up. So if the snake initially sold the bananas at $10 and the price of the bananas triples, right? Because of the banana pudding craze of 2020, and the price of the bananas go to 30, the snake is forced to buy the bananas at $30. So he borrowed the 5 bananas from the gorilla, sold them immediately for $10, is waiting for it to go to $2, but it spikes up to 30. And then over time, well, the snake's like, well, I guess this is the new price of the banana. So I've got to buy it. I've got to buy them at $30. So only made $10, bought them at $30. So that means the snake, to settle his debt with the gorilla for borrowing the bananas, the snake is losing $20. So as you can see from this example, had the snake gone long instead and lost all of his value, right? So say he bought it for $10 and the value of the banana went to $0. He'd have only lost 100% of his account, because when you go long, you can only lose 100%. The danger of a short squeeze is that shorts can suffer infinite losses because a security can go over 100% in price. So here's what happened on GameStop. And this is not a fanatical example. The price of GameStop went up 30 times over the course of the past month. It started at $30 It started at $30 at the beginning of this month, and it spiked up to $500 today. So it's actually more than 30%. So say in this example, the snake borrowed the bananas at $10, and he goes to the market to cover his short, and the bananas are $300 for 5 bananas. So the snake is underwater 2,800% of his trading account. And this is what happened on GameStop. So the most important aspect of this to understand is that short sellers can suffer infinite losses because securities can go up over and over and over percentage-wise. So when GameStop goes up almost over 3,000%, anybody who's short, they owe 3,000% of that money. So if you bought in for $100, you now owe, what's that, $30,000 or $3,000. Is that right? Yeah, that's right. So if you bought in, if you shorted $100 worth of GameStop stock, you now owe $3,000. This is an impossible situation. This is why we saw what we saw today, where we saw Robinhood, we saw TD Ameritrade, where they were limiting trading. We're talking about billionaires who are underwater for billions. We saw hedge funds getting bailed out yesterday by other hedge funds. So how much does it cost to pay millions of dollars to Robinhood to limit trading? Like, the powers that be, they showed their hand. They showed their true power because of how much loss that you can suffer in a situation like this, 3,000% losses. So to protect the situation, so here's what brokers do. Because guess what? If I only have $100 in my trading account and I owe you $3,000, how am I going to get my money back, right? If you owe me $3,000 but you owe me $100, how the heck am I going to get my money? So what brokerages do is they have a for short sellers, because they can suffer infinite losses, they have what's called a margin call, where when you go short on an exchange, you agree that you only can take a certain amount of loss and you're forced to buy your book. Because when a short, remember, like, initially the snake sold those $10 worth of bananas to exit his position. To get those bananas back to the gorilla, he has to buy. And what does buying do? Buying decreases the supply and increases prices. So the reason why the GameStop short was so magnificent and such a historic phenomenon is because these shorts were already underwater 3,000%, and they're holding on. They're holding the line. They're trying to not buy back the stock, because if they do buy back the stock, then guess what? They're in for millions of dollars. The price goes up. This is why people on Reddit were predicting GameStop going to $1,000. And this is still possible. The short float is still over 100%. So the short float means that almost all the GameStop shares are shorted because of the situation of everybody buying online games. So this is the powder keg scenario that we're in on GameStop. So let me remind you, remember, GameStop, it's losing value. You've got online gaming. You've got the pandemic that is setting the stage for a situation where clearly GameStop's going to go broke. Well, and so you've got this high short interest where the number one stock on the stock market right now that's being shorted is GameStop. Like, there are more shares short than actually exist on GameStop. And so that's why it's been behaving like a penny stock, because when you short, remember, like to short, I had to borrow those shares from the gorilla. So that means those shares they're not available for trading because I borrowed them. They don't exist. Like, to give them back to the gorilla, those shares aren't available for trading. So this is what I've been learning from as I've been reading about this. What I've learned is that brokerages, they offer shares for short even if they don't have them yet. So the reason why you can have more short shares shorted than exist is because brokerages are pretty much saying like, oh, well, like, I don't have to make due on this because most of the people who short are going to make due on their bet and they're going to buy it back. So I don't actually have to own the shares. With that being said, going back a year ago, this user on Reddit, Deep Effing Value, is a legend in the Wall Street Bets community. Here's why. He saw this a year and a half ago. He took a large position. He spent $50,000. If you see on this at the bottom of the screen, he took a $50,000 position, and as of yesterday, he was up 22 million on GameStop. That $50,000 short that he saw a year and a half ago. So this is the situation that we're seeing. We've got Wall Street who's betting more shares than exist on betting GameStop to go down. Someone a year ago saw the situation setting up on Reddit, and he said, I'm gonna bet. This doesn't make any sense. Like, how can you short more shares than exist? And then he actually has a YouTube channel. His YouTube channel is called Roaring Kitty. We got this deep effing value. He's an overnight internet celebrity. If you were to go to the Wall Street's Reddit page, like, literally his post is number 2 on the page because he's updating people in real time. He's been updating every single month since a year and a half ago. So you have this situation where you've got this powder keg set, where you got Wall Street Bets, and this guy is on Reddit, And he wasn't, you can see that there's only 46 likes on this in the top left corner. This wasn't that amazing. Like, it was just incredible. Like, why the heck are you going long in GameStop when everybody's shorting it? Well, this is the tweet that set it all off. January 19th, 2021, Citron Research, a guy by the name of Andrew Left, he recorded a YouTube video. I couldn't find the YouTube video because they might have taken, I think they took it down. They literally were talking trash to people who are going long in GameStop. So if we read this tweet, Citron will live stream the 5 reasons GameStop buyers at these levels, and these levels being $30, are the suckers at this poker game. Stock back to $20 fast. We understand short interest better than you, and we'll explain. This is what set the internet off. So on Wall Street Bets, you have this guy, Deep Value, who saw this a year and a half ago, and you got this guy on Twitter who set the stage for talking crap to anybody who's going long. And then you've got this group of traders who've been theorizing about GameStop being overshorted. And so now he's poking the flames of this fire. And so they all started posting in the Discord channel for Wall Street Bets, and on the Wall Street Bets Reddit channel itself, they said, buy GameStop, F this guy, F the hedge funds, let's screw this guy over. And that's what started this whole thing about 2 weeks ago. And so then we saw GameStop go from $4 a year ago up to $500 today. This is the story of how a short squeeze happens, and this is the story of GameStop. Comments, confessions, thoughts?
Yeah, I got a quick question. For this to happen though, like Reddit, I mean, I'm not saying there was no inside information or whatever, but like what you said, that guy sent out that tweet or whatever. Wasn't this like a combination? I mean, this don't happen a lot, or maybe it does, I'm not sure. But something like this, didn't certain things had to line up just right for this to happen? Right. I mean, because the way the hedge fund people, it was like they were big and bad and all this, and then the normal people like David came and slayed them and made all this money. You know, so I'm just saying, so to see this, like you're a lot better than all of us. Is this something that you kind of seen too coming, or as it was unfolding, you said, hey, this is something here?
So I did not see this in advance. I was not aware of this, but I saw this situation and I understood when I saw GameStop at $60 and I looked at the short float and I saw that it was over 100%. I knew immediately that it didn't make sense. Okay. You can't have every share in existence going down. Right. That means that there's no shares to trade. And if there's no shares to trade, then that means any buying pressure is just going to drive it up. And it's a self-fulfilling prophecy. So because there's only 100, so if we look at the short float, like if we go to finviz.com, or not the short float, we can look at how much. So when we say the float of a stock, so the float, so the shares outstanding, right? Can y'all read this? This is really small.
Yeah.
Okay.
I can see it.
There are only 65 million shares of GameStop. So this is a very small amount of shares for a stock. So the number of float shares, so there's 65 million shares, and then the float means there's 50 million shares that are available for trading. So the float means even though there's 65 million shares in existence, there's 51 million available on exchanges. So we have a short float of 100%. So it's already a low float. This is an incredibly low amount of shares. So we have a low amount of shares. Every share is short. Low amount of shares. Every share is short, and so that means that there's this small subset of shares that are actually being traded. So like, let's even call it like a million shares, right? It's actually probably even less. If there's only 1 million shares, then like any price fluctuation, like it only takes $1 million the stock price was like $30 at the time. So if it's $30, if there's only 1 million shares that can be traded and they're worth $30 each, that means it only takes $30 million to double the stock price. So if it's worth $30 million, because everything's locked up, right? When you're shorting a stock, you lock up the stock. So if the stock is locked up and there's only $1 million, it only takes $30 million, and you have all these people online who are buying this stock. So to double the price from 30 to 60, it only takes $30 million. And so now you've got $60 a share and 1 million shares. Now it only takes $60 million to go from $60 to $120. Like it was this was a very special scenario where you got, go ahead, DeFazio, my bad.
So you know, one of these things I want to point out. So there's another 2 factors that helped this like explode like it did. Like, cause like Josh has been explaining that this has been amazing. Never seen anything like that. This is very historical moment in time with this in the stock market. But one, when you are going short, you like Josh said, you have to borrow shares from the broker, and somebody at that brokerage firm has to own those shares, or that brokerage is like, I'm gonna cover them, I'll get them somewhere later. So in order to do that, they had to have permission from the people who own those shares.
Right.
To be able to short those shares. So when you sign up for your brokerage firm or your brokerage account and you sign up for options, you probably in all that writing, the things terms and agreements, you probably checked off like, yes, I will allow my shares to be shorted if somebody's asked to. So what those people in Wall Street Bets did, they conspired with their cohorts and like, call your brokerage firm, tell them you do not want to lend your shares out to be shorted, because what somebody can do who's in a bad short position, they can just short more above where the price is, and hopefully that it continues. It can go down from there, and they'll make some money there. So that's one thing. There was the share short. They couldn't do that part. And number 2, when there's a margin call, like you are forced to get out the position or forced to put some money into the position so you can cover your costs, cover your short. And so like Joshua explained, like, so they want to hold tight. They don't want to buy, because once you buy, that's triggering buying pressure. And as more and more people get margin calls and you got more buyers than you got sellers, there's nothing it can do but go up and continue to rise. And it's going to rise exponentially at times because those positions are so large. Like 100+% of shares short is astronomical. Like, I don't know how they can even let that happen. Like, I mean, I guess they make a backdoor handshake deal and let that go down. But those things are self-manifesting. They build on each other, and they just cause for that parabolic return that we've seen. And I wish I was on Wall Street Beats and I could have participated, but I am not.
Yeah.
I wanted to add that in there to help further explain how it's been so impactful these past couple of weeks in the stock.
Yeah. Go ahead, Mr. Harris.
One more comment on what Mr. Fields was saying. When I was looking at my Webull account, they were saying this, about how, you was talking about they can take your stocks and do something with them. They saying I need to turn off my stock lending income program. Is that sort of what you're talking about? Is that what, then that won't give them permission to short or whatever do with your stocks? Okay, so that's what people were saying. Hey, yeah. Now, but back to what you said about the 65 million shares of stock. Okay, if they only got that amount of stocks and people were buying them, for me to buy somebody's stock, somebody got to sell some stock, right?
That's right.
But then who was in their right mind selling the stock? It was them hedge fund people?
So who's selling the stock? So that's probably people. People all around were saying, I got a text immediately when GameStop popped to $30 from $19. I literally got a tweet. Someone hit me in my Twitter DMs and was like, yo, like, did you see GameStop today? Like, I just sold at $30. It was amazing. And I was like, oh man, that's awesome. Like, I didn't see that move.
Okay.
Yeah. So, because it's all relative. Because at the time,
right.
It had spiked 50%. Yeah.
Right. So people are going to take advantage of their gains and think, oh, they never imagined it was going to 300. So I done made double money. I'm selling mine. And then somebody came behind them and bought those. Okay. I see. Right, so there's always going to be a trade and a sell-off. Okay.
Right.
And also, if there's not a person on the other end of that transaction, the brokerage firm will take that action.
Okay.
They're like, big hedge firm X, they see the inequities in GameStop and they want to exploit them. So I'm gonna short it. There's nobody that wants to sell them. So brokers were like, I got you. I'll take this action. And so they take the other side of that transaction. Hopefully that they can make the money on the end.
But if they get caught up in a whirlwind and don't have the coverage, I mean, stuff can get really bad. And like some of these hedge firms are going out of business because of this.
So that's what Webull or Robinhood does for us. They when I say, okay, I want to buy some stock, they reach out and try to find the stock no matter what for that I'm trying to sell, buy with it.
They're like a market maker.
Right.
A whole bunch of people interested in buying and selling stock, and they just got all these orders from both sides, and they're just taking them and matching them up.
Okay.
And they can't match them. Like sometimes they'll take the action, they'll take the bet. Like, and that's in essence what they're doing when they're shorting it, because they're not actually physically removing the shares from somebody's account, saying, "Oh, somebody sold your shares short." They just have that. It's like an accounting thing. Like, so you are in that bed with the brokerage firm, not another person.
Okay.
Yeah, so that takes us to the next step of this, which is how the heck do we avoid getting what happened to Wall Street happening to ourselves? So the first step is I'm going to tell you who I am and why I'm qualified to give this presentation. We're talking about a modest betting proposal that's going to set the stage for the rest of the presentation, which is we're going to talk about risk of ruin. If you go all in with your account, very often you're going to run into consecutive losses. Like you're mathematically guaranteed to, based on your win rate, and we're going to talk about that too, based on how often you win, you need to be sizing your bets based off of your win rate, because if you go all in every time, remember, losing hurts you more than winning helps you in this game. So with all that being said, talk about risk of ruin, how losing money hurts you, how to size a position, asymmetrical betting. So asymmetrical betting is where you bet $100, but you're targeting making $200 or $300 at a time. This is how you get around the death knell of mathematics, being that losing hurts you than winning helps. So the way you get around that is to take an asymmetrical bet where you win more than you lose. We're going to talk a little bit about evolving R. Evolving R, so R stands for risk. Evolving R means that and we're going to actually go through my AMC trade. My AMC trade where I got in at $2.91 and I sold it at 12 bucks. So I 4X'd that position. We're going to talk about the evolving R. So as you get closer to target, your risk reward ratio actually changes, because if you're 80% to target, you're now risking 20%, and you've got 80% at risk, and you're only looking to gain 20%. So as you get closer to your profit target, you're further incentivized based off of the risk to reward ratio. If you've got a better opportunity in the market where there's a better risk to reward ratio, you're very highly incentivized to take your position off, cut it off early, and to get into a situation where your risk to reward ratio is more favorable. This is what's called evolving R. Finally, we're going to talk about opportunity cost. If you don't take losses quickly, you're hurting yourself in two ways. One, you've got money tied up that is not being devoted to a better situation. You've already lost. And two, the bigger your losses get, the worse. Like if you take a 10% loss, it takes like 12 or 13% to make up 10%. I mean, we talked about the 50%, 100% example. The more you take losses, the more it takes for you to come back. And then we're going to talk about how to thoughtfully increase your risk size. So who the heck am I? So if you guys remember that last presentation, we were talking about me. I'm effectively a techno fundamentalist who specializes in finding penny stocks with blockbuster fundamentals. That's literally what I do. So I'm not a historian. I did tell you guys a story. I think it was a very entertaining one, but I'm actually a real investor. And I mean, here's me texting Leslie. You guys saw this last time, which is I texted Leslie April 15th. I was talking about the RVP stock. At the time I was texting her, it was $2. It went up to $15. This is me buying it back in April of last year. March 26th, I was telling my friend about GRWG. I found it at $4. I ended up getting shaken out of it during the pandemic, ended up getting back in for $8. It's now at $50. Yeah, so that was GRWG. I don't have a chart on that. So that was what I was talking about before, but the game has continued. The game must go on. And in DM, I found that recently at $4. I posted this in Black Wall Street. I posted when I went long in DM at $4. It is now at $15. AMC, I posted when I went long at $2.91. I sold it at $12. you know, it's nice to see charts, but guys, this is like this is a screenshot of my account like 2 days ago. I'm the real deal. Yeah, I actually made what is equivalent to an annual salary for a lot of people in the course of 8 days off of trading. And so I'm highly qualified to give this presentation.
Hey,
I wasn't
let me
GameStop.
hold
Can
something.
we pause for a second and just
Yeah, I
give a
know.
little
Can we get go ahead, Josh? You know, our fearless leader. Let me hold something. I'll pay you back.
Go ahead, Josh. You cool. Let me hold $2.
$2. I'm more expensive than that. I've been having my eye on this YSL bag that I need to don't. You know what I'm saying? All right, continue.
I appreciate it. Yeah. So I was in GameStop. So this is actually my friend's account, and he literally bought it at $97. I was incredibly pissed at the time because he broke all the risk management principles that I was talking about in this presentation. He panic bought at $97. And I was like, well, shoot, I'm looking into this, and this really does have a lot of potential. I'm looking at a lot of shares that are shorted. And so we ended up selling it at, we bought it at $97 and we sold it at $370 for a 370% gain on, so for a profit of, I think, 20,000. Yeah, I think it was like either $15,000 or $20,000 over the course of a few days. So yeah, I'm the real deal. So with that being said, just want to give you guys a modest betting proposal, which is, let's just talk, we're going to be talking about gambling theory, which is going to set the stage for our process for risk management. So gambling theory, flip a coin. If I win, I get $1. If you win, you get $2. Would you take this scenario?
Yes.
Yes, guaranteed. Yes, this is absolutely a winning situation for you, right? Well, guess what? Depending on how much money you have, you actually can still lose all your money. Because if you have $3, right? If you have $3 and you and I are betting $1, the probability of you running into 3 consecutive losses is non-zero. So when we're betting on stocks, we always have to consider our risk of ruin based on our win rate. So with that being said, I'm going to say this a few times. Very few people actually follow this advice. You need to be tracking your trades. You need to know what your win rate is. When you take positions, you need to know how often you win, because based off of that win rate. So if you have a win rate of only 5%, that's what this chart shows. If you have a win rate of 5%, you are mathematically guaranteed to have a consecutive loss ratio of 100%. That makes sense, right? You're only winning 5% of the time. But say we're doing the flipping coin situation, right? Up to 4 times, up to 4. Like if you have $4, there's a very high chance that you're going to have if you have a 50% win rate, you're mathematically guaranteed to lose 4 times in a row. So say you're betting 25% of your account on every single trade, and you're losing 25%, losing 25%, losing 25%, you are mathematically guaranteed, if you only win 50% of the time, you're mathematically guaranteed to lose all your money. You can't beat math. You can't beat math. It is one of the only things in life that is certain. They say the only thing certain in life is death and taxes. There's another one. It's mathematics.
Data.
So on a 50% win rate, even if like you've got a $10, right? You're sitting there with $10 and we're betting where I win $2 and you win 1%. There's still a 9% chance that with $10, there's a 9% chance that you lose 10 times in a row. So with that being, I'm giving you the scope of gambling theory, and we're going to circle in based off of these ideas. We're going to circle in on a best practices template for approaching risk. So risk of ruin. You will have consecutive losses in your trading based off of your win rate. So 1, you should be tracking your win rate. 2, you need to be considering the size of your trades, because you're mathematically guaranteed to run into a string of losses. Even at a 95% win rate, you can still, at a 22% probability, lose 2 trades in a row. So your bet sizing matters. Like you can't just be going all in. You can't be like all these guys on Wall Street Bets. There are countless posts of people losing millions of dollars and ruining their lives on Wall Street Bets, losing hundreds of thousands and millions of dollars because they're going all in with all their life savings, it is a recipe for disaster, because based on what we just saw, you are mathematically guaranteed. You cannot keep doing that. You're mathematically guaranteed. Unless you have a 100% win rate, you need to be considering the size of your positions. Losing money hurts you more than making money. So if you lose 20% of your account, so you've got $100, you lose 20%, you go down to $80. To go back to $100, you need to make 25%, because 25% of $80 is $20. So it takes more to get back than when you lose. So that means you need to be, so one, what we've learned so far is you will lose. You're going to lose, and you're going to lose in no one has a 90% win rate. Like, you're going to lose consecutively. Two, losing hurts us more than winning. So that's where we're at in the theory. Yeah, I put hashtag math on this presentation. You can't escape this. How much you put in matters. Losing hurts you more than winning helps. You will lose. You beat math by winning more than you lose. This is the solution to this problem is asymmetrical bets. So if you have a win percentage of 50%, and I'm paying you $2 versus you paying me $1, that's how you get past the situation of running into consecutive losses. So when we take trades, every trade I take has a minimum risk to reward ratio of 2 to 1. And the reason why that is because when you have a risk to reward ratio of 2 to 1, you only need to be right 33% of the time to break even. That should be probably a shocking number to most of you. If you don't know gambling theory, that should be a shocking number to you. You're saying if I win twice more than, so wouldn't it be like 50%? Like, wouldn't it be 50%, Josh? Well, no. The reason why is, so say we take 99 trades, right? If we take, I wish I had a slide for this, but let's see. Let's go into Google docs.google.com. And let's talk about how the math works out, where if you win 2 times more than you lose, you only need to be right 33% of the time to break even. So say we start off with $99. And all of our trades are a 2 to 1, 1 to 2 risk to reward ratio. So say we take 66 losses, right? We lose 66 times. 66 times we lose. So now our $99 is now $33. So if we have a risk to reward ratio of 1 to 2, and that we win 33 times, 33 times $2 is $66. And so 66 plus 33 is back to $99. So the way we get around consecutive losses, and we get around losing hurting us more than we win, we want to put ourselves in scenarios where what we stand to lose is much less than what we stand to gain. So if you're a beginner, I recommend you target trades where you are looking to win 3 times your losses, because a 1 to 2 risk to reward ratio, you only need 33%. You only need to be correct 33% of the time to break even. A risk to reward ratio of 1 to 3, you only need to be right 25% of the time. 1 out of 4 times to break even. This is a gold mine. This is going to keep you alive when you're a noob and you don't know what you're doing, because you only need to be right 1 out of 4 times to not lose money. So we talked about gambling theory. I've already said that multiple times. How much you put in matters. Losing hurts you more than winning helps. So we're going to talk about how I took the AMC trade, what the risk to reward ratio was, why I was excited to take the trade, even though it was in a bevy of uncertainty. So if you look at the AMC chart, I tweeted this a few days ago. I said, dude, there's so much buying at the bottom of the AMC chart. Let me see. This was my tweet. I said, on January 15th, I said, there was a massive amount of buying at the AMC bottom today. So I looked at the chart And at the bottom, so I think, Leslie, you did alert me to this. So shout out to Leslie. You literally made me 30 grand, 40 grand, or what? No, I think you made me 50 grand. Because
So what's my cut?
This presentation.
No, the presentation.
It's some service fees or
That's
something.
what I'm trying to figure out.
So I saw this
We'll
situation.
talk.
And it was a situation where you had tripled the normal volume at the bottom. And then I went to finviz.com and I saw something that was really interesting. I looked up AMC, and if you know me, I love this line item on finviz.com, institutional transfer. What are hedge funds doing in the stock that I'm looking at? What I saw massive buying, and I went to finviz.com and I saw institutional transactions, people with huge accounts, hedge funds, really rich people. There was a 32% increase over the course of the past 3 months of hedge funds buying AMC at the bottom. So I saw bottom buying, and hedge funds move markets. People like you and me, retail traders, we only account for 20 to 30% of stock market value. The high frequency traders, the market makers, the hedge funds, the institutions, they account for 70 to 80% of stock market value. So this is like a big hint of like what I like to do. And you guys know I did this presentation. This is in the CAN SLIM. CAN SLIM is current earnings, A is annual earnings, N stands for new technology, S stands for supply and demand levels, L stands for a leader in its market, I stands for institutional ownership. You want to see institutions getting into the stock. So I saw institutions were getting in, and I saw massive buying at the bottom, and I saw a risk to reward ratio that was incredibly favorable. So I looked at the bottom. So here's what I saw at that time. This is what I was looking at right here. I was looking at this. I saw an engulfing candle. So if you guys study technical analysis, so I'm going to go into like all the details because I think there's a lot to be learned. An engulfing candle is a technical. So I'm a techno fundamentalist. I like to combine fundamental factors and I like to add technical factors to it. A bullish engulfing pattern is when the daily candle closes and it completely engulfs the candle that existed before it. This is incredibly bullish because that means that the stock opened at a lower price than the previous candle, and it closed higher than the previous candle. That means that the short sellers were driving the price down and buyers stepped in and drove the price higher than what it was the day before. So I've got an engulfing candle, I've got institutional investment, I've got a stock that was at the time when I looked at FinViz, I'm looking at AMC Theaters, and it was only worth $450 million at the time. $450 million for like a movie theater company that's got all these movies. It's the biggest movie theater in the land. Like, so what I didn't know at the time is that they owe $7 billion, but like essentially it was incredibly undervalued. And like, I didn't have to do the math on it because the hedge funds were getting in. That's the smart money. I just follow the smart money. So I'm going to the chart. We're at the historic bottom. So this is just technical analysis stuff. AMC has bounced back from this $2 to $3 level multiple times in its history. So I'm looking at, it's at the bottom, you've got historic volume. It's never seen volume like this for years. And what is my downside? My downside is it drops to like $2.50. So I went and I did the risk to reward ratio. I said, okay, so you need 4 things when you're taking a trade. What is your thesis? Why do prices move? Prices move when people buy after you. That's why prices go up when there's buying pressure that exists after you buy. So whenever you're thinking about a trade thesis and you're going long, you always want to think, why are people going to be buying this stock after I buy it? And so that's the reason why you never want to buy crap when it's spiking. When it's spiking, say we look at GME, we look at Gamestop, and say we're on the daily chart and you're looking at the stock and it's here, right? Let me draw. It's here. The reason why I was upset at my friend who bought GameStop at $100 is you want to buy low and sell high. You want to be buying, and I've said this in the Black Wall Street chat. You want to buy fear, sell greed. This is already greed at $97. This is the highest price. You want to buy it when people are scared. Like people, like in other channels that I'm in, when I told people I was getting into AMC, they thought I was foolish. Well, guess what? Who's laughing now with 60 fucking grand? So with that being said, so this is when you enter a trade, there's always four things you want to know. What is your thesis? Why are people buying after you? What is your entry price? At the time, when I was looking at AMC, the entry price was $2.91. It was $2.91. And I said, okay, when am I going to cut? This is the most important step of the process, what I'm about to say. If there's nothing you remember, when you take a trade, always know where you're getting out. Always know where you're getting out. Because this allows you to position, this allows you to size your position. We're going to go through the math of sizing your position. So I've got a risk analysis spreadsheet. So at the time, I had $37,000 in my account. And my entry price was $2.91. So I'm looking at the chart. Where am I going to get out? I've got 37 grand. Where the heck am I going to get out? So what I said was, you know, the engulfing candle was really bullish. I'm just going to, and there was a gap up. I'm going to get out if it drops to the bottom of the gap up. So this is a gap up where it gapped up over the price of the previous day. So that level, and I see, if you see, I have an alert. That alert, that's going to get sent to my phone when it drops down to $2.58. I go to TD Ameritrade and I sell the shares. I don't think about it. It's done. I'm gone. So I set up an alert on TradingView, $2.58. So I've got a $2.91 entry price, and I've got a stop loss at $2.58. So I was able to size 62, and I trade with a high risk level. And that's due to my win rate. This is not recommended. What I do recommend, if you're trading in these markets, I recommend, and this has to do with that whole risk of ruin thing. You need to be trading a 1%, 2% is considered standard for a trade. 3% is considered very aggressive, and 0.5% is considered. This is a very important part of the presentation. So this is considered 0.5% is considered conservative. 1 to 2% is considered standard, and 3% is considered an aggressive risk level. So when I say 3%, so let's just say my account size was 10,000, right? When I've got 3% at risk for a very aggressive, so I'm in freaking Space Jam. I'm on a completely different planet of risk because I'm trying to become a millionaire in the next 5 years, and that requires risk. And I dampen that risk by taking trades with very high risk to reward ratios. So I'm only risking 3% of my account. So if you don't know anything about gambling theory, you would think to yourself, you'd say, I'm risking 3% of my account. So I've got $10,000 and you only want me to trade $300, Josh? Well, no, that's actually not how it works. So it's based off of where you get in and how much you're risking per share. So I've got $300 at risk for a $10,000 account. People are calling me on Discord. I'm actually giving this same presentation in a Discord channel as of 11 minutes ago. I'm late. They're gonna have to wait. Okay. Let me tell them. Hold up. Where are you at? Your event is now. Hold on. Give me 20 minutes. Okay. Back to this. Let me call you back in 20 minutes. Bye. Okay. 3%, if I'm risking 3% of my account, $300, right? To actually risk $300, I can actually still size 25% of my account. It's like, can you guys see this? Like, can you guys clearly see these numbers? Yes? Okay. So if I'm risking 3% of my account, based on my stop loss, I'm not actually gonna lose the entirety of that if I put in $2,600 or 26% of my account on that $10,000, I'm not going to be losing that entire, if I take a loss on the trade, I'm not losing the entire $2,600. So the reason why you have a stop loss is it allows you to size larger in your account, but you're still only risking $300. So at the time, I trade with, based on my win rate, based off of my risk tolerance, I trade at 7% per trade. My recommendation to you is to be somewhere in this range, which is 0.5% at a conservative level, 1 to 2%. I've traded at 1% risk for years in the cryptocurrency markets, and this 7% thing is some new shit for me. An aggressive risk level is 3% per trade. Anyway, 7%, you want to know your thesis for the trade, why are you getting in, what is your entry price, what is your stop loss price. Most interestingly, what was my take profit price on AMC? Well, if we go back to more technical analysis, I trade on the weekly charts. So when you're looking at support and resistance levels, I only saw two levels where, so a resistance level is so let's talk about support and resistance. A resistance level is a level where a price goes to, and a lot of traders in the past have sold at that price. So that means it's very likely to reach that level and drop back down. A support level on the chart is a level that when a price falls to it, buyers have stepped in at that time and drove the price back up. So when you're trading on the weekly charts like I do as a swing trader, I look at the chart and I say, what levels were interesting to traders in the past? So I only saw two levels. So I was at $2.91. I only saw two levels that were interesting on the weekly charts. So I saw a take profit at $7 because there was risk. See all these spikes and how they ended at $7. So I saw a resistance at $7 that wasn't just based on experience. It's not a very critical amount of resistance. The reason why is because there wasn't that much trading. There was so much trading volume on AMC on that day. It exceeded all the volume in the past at that resistance level. So I didn't take that resistance level very seriously. The resistance level that I did take seriously was the $12 level. $12 level, you've got resistance coming, you've got support coming in back in November 2017, support coming in again, support serving as resistance in August of 2019. So we're talking about technical analysis concepts right now. And I know I'm losing a few of you. So, but like, this is simple stuff, what I'm talking about. You just go to support levels, Investopedia. You'll get more information on what I'm talking about. Support and resistance basics, Investopedia. Go here. So I'm looking at the chart, and what is my risk to reward level? So in my mind, I planned the trade 8 days ago. 9 days ago, I said to myself in advance, I said, I'm going to sell half at $7 and I'm going to sell half at $12. So I entered long at $2.91, and I knew exactly what I was going to do at every single price point that was relevant to me. $2.50, I'm getting out. $7, I'm selling half of my position because that's a somewhat significant resistance level. $12, I'm all out because that is going to be a significant level. Well, guess what? If you look at the way the price action has been trading, especially even today and tomorrow, $12 was an incredibly significant level on the price because when it spiked up and rose and the market opened at $20, it dropped down and found support at $12. Like these support and resistance levels, it's not bullshit. It's not just theory. Like this, you can see that it actually happened in reality. Like, anyway, all that being said, in advance, I knew what my thesis on the trade was, what my entry price was, what my exit price was, what my take profit price was. My risk to reward ratio was $12 divided by $2.91. My risk to reward ratio was was 4.12. A risk to reward ratio of 4.12 means that I only have to be right. You always add 1. So like just like 1 out of 2, it's not 50%. You always add 1 to your risk. You only need 33% to break even on a risk to reward ratio of 2. So I had a 1 to 4 risk to reward ratio. I always add 1. I only needed to be right on AMC 20% of the time to be successful. So if I take that trade 5 times, I only need to be right 1 time to break even for all 4 of the losses. This is the holy grail of trading: risk management and asymmetrical betting. This is how you trade like a hedge fund manager. Entry price, thesis, stop price, take profit price. Your take profit price should be at minimum a 1 to 2 risk to reward ratio versus your distance between your entry price and your stop loss. This is the core of this presentation. I described all those gambling theory things to lead you to this final situation, these best practices. What else is there? Position sizing, evolving R. It's kind of advanced. I don't want to get into that. Taking losses. Taking losses quickly is very important because of what we talked about, where if you take a 20% loss in your stock, it takes 25% to recover from that loss. So taking small losses, the reason, even though for me at an aggressive risk level, I'm only going to be losing 7% of my account on a trade. Like if everything blew up in my face and I was completely wrong on AMC at $37,000, I would have lost $2,590. I would have stayed alive. I would have been able to keep fighting in the game. 7% is an outrageous risk level. I don't recommend it. At maximum, I recommend 3% to everybody on this call. If you're, you feel kind of squirrely, 7% is something that I will never go beyond because the risk of ruin, I can't beat math. My win rate, I can't withstand. At the time when I calculated this my win ratio was 70%. And so if we go back to that chart on the presentation, if we go to a 70% win rate, you can see how many losses you can take in a row. So we'll go back. If my win rate is 70%, I'm mathematically guaranteed to take multiple losses on two trades in a row. So at 7%, so I'm over in the middle of the screen. If I risk 7% of my account per trade, there's a 2% chance, or at a 70% win rate, there's a 2% chance that I ruin my account by running into 7 losses in a row. So to me, that's good enough. And that's close enough based off my 70% win rate. That's the reason why I trade 7%. I'm never going to go higher than that because that is the absolute ridiculous maximum. I recommend 1% per trade to everybody on this call. With that being said, you want to cut your losses because losing, not only do you lose by not taking your losses quickly because it takes more money to come back, but you also lose because you lose on the opportunity cost of deploying your capital in a place where you're actually going to be winning. So when you're sitting there and you're holding a loss, which is the standard human psychology for taking losses, the standard human psychology is to cut winners when you win and to actually hold losses until you get back to break even. You want to flip the script. You want to cut your losses with your losses with reckless abandon, and you want to let your winners run. This is how you win in the markets. Always trade with a 1 to 2 at minimum risk to reward ratio. Only risk 2% of your account on a trade. And the way you calculate that is you calculate the distance from your entry to your stop loss. So for me, it was $2.91 versus $2.58. So that means I was risking 33 cents per share. So if I'm risking 7% of my account and I've got 2,000, so 7% of my account, $2,590, you're probably gonna have to look back at this presentation. If I'm risking 33 cents per share, how many shares can I buy? I do 2,590 times how many shares at risk is it? Or I divide it. So I divide how much, what is 7% of my, so let's just do a simpler example. Let's do $10,000. If I got $10,000, I'm risking $700. So if I divide $700, which is 7% of my account, divided by the distance between my entry price and my stop loss, $700 divided by the distance from my entry to my stop loss, that's going to give me how many shares I can buy, divided by 0.33. And that's what this calculation in the top right corner is, right here, 2121. And that tells you how, so I've got 61% of my account in my trade. I'm only risking 7% of my account, even though I've got almost an all-in trade, but I'm still within my risk management principles. Guys, that's pretty much this presentation. This is how you stay alive in the markets. This is how you avoid a situation like GameStop where you're suffering infinite losses. You always enter every trade with a thesis of why you're entering the trade. So that keeps you from making emotional trading. You always know when you're getting out, and you always want your take profit to be at a minimum of twice of, you're going to be winning twice plus 2x plus of what you'd be losing on the trade. And that's it.
Questions, go ahead.
Okay.
Hey, John, could you pull up something for me right quick? I want you to look at one of my stocks right quick. It's SID, SID.
Okay, hold on. Does anybody have any questions about what we just spoke about first?
All right. Okay.
So that
That was
spreadsheet
it.
that you sent, can you send that to me so I can send it out to the group?
Yes, I can share. I mean, don't mess up my chart, y'all.
No,
I'll share.
well, if you send it to me and I will copy and paste it and send it to something separate so it doesn't mess up your Google Docs.
Okay. All right. Yeah, I'll send you the link,
Thank you.
Leslie.
I won't have questions today. I got to rewatch.
I was gonna say, I don't know how to ask my question. I think maybe it's just because it happened so quickly. So this is the same theory that you go into all your stocks. It just happened that AMD did it, or AMC did its thing all in like a couple of days, which is why you were able to like do all this so quickly. I guess my question is like, this is not typical for
my trade thesis, right? You're asking about why I decided to go into AMC?
No, not that, but I'm just saying like the theory behind it, because it seems like you implement this for like all the stocks that you do.
Yes.
I'm saying this just happened to.
It just, I had no idea that this was, so I got very lucky. The reason why I got lucky is because Gamestop is considered very similar. So if we look at highshortinterest.com, if we go to highshortinterest.com, AMC is GameStop is number 1 on this list with 133% float short. Number 3 on the list is AMC movie theaters at 68%. So as the GameStop event happened, there's a thing called sympathy plays in the stock market. Sympathy plays are like when Tesla took off, lots of electronic vehicle stocks also took off in addition to Tesla. So a sympathy play in the stock market, my position in AMC ended up being a sympathy play to GameStop taking off, because other people were saying, okay, what other stocks have a high short float? Well, guess what? AMC was right there. And so I got lucky because of what happened on GameStop affected my world in AMC.
Okay.
Does that answer your question, Nesha?
Nisha.
Nisha,
But yeah,
my fault.
I guess I don't even know what I was asking, but yes.
Okay.
It just all happened so fast.
Yeah.
Everything happened.
Oh yeah. So I could not.
The stocks.
No
So
idea
it's
that
like,
was gonna happen. Yeah.
I may have missed it. I have a question. How do you calculate the I guess the trend in prices, like how far it's going up and how far it's going down? Like how do you put that in the graph?
So okay, you're talking about the trend in price, how far it's going to go up. What are you talking about? The support and resistance levels?
Yeah, support and resistance. Yeah, I said it wrong.
Oh, okay. So you're asking how I do that analysis?
Well, how you put it in the chart, I guess, to do it. If you've already covered it, I can go back and watch it.
No. So this is, I use tradingview.com and I'm looking at the AMC chart. So it's an eyeball thing. And so we look at support and resistance levels. So the theory of this is that I look at previous areas of price action where traders were making trading decisions and getting into a stock or getting out of a stock. So you recognize that by what's called a swing high or a swing low, where you saw the price it's downtrending and then it stops and then it goes back up, or it's uptrending, stops and it goes down. When that happens, those are called swing points. These are called support and resistance levels. So the way I draw it in TradingView is there's a drawing tool on the left side, and I click the straight line. I hold down Shift. So without holding down Shift, it allows me to draw it any way I want. Holding down Shift forces it to be a horizontal line, and then I just draw it at 12 because I saw that there's a lot of price action at 12. Lots of action at 12, so I draw it there, and I saw that $7 was a previous area of interest for traders making trading decisions, so I drew a level at 7 also.
I got you. And one last thing, I guess, to follow up, do you always stick to the 5-day view, even for like a play that may be like in March? Are you looking at a 5-day view, 3-month, or how long?
That's a great point. Yeah, I make the vast majority of my trading decisions on the weekly chart.
Okay.
Because I know that hedge funds make most of their presentation or make of their trading decisions on the weekly and monthly charts. And the name of the game that I like to play is I like to follow hedge funds. Like the most important statistic to me for every single thing I get into is that institutional ownership number. That's the source of my edge in the markets. I'm looking for that institutional transfer number to be going up. I want to know that hedge funds that have got their eyes on this because they account for 70 to 80% of stock market value. So if there's anybody who's going to be buying and driving my shares up, like that's what happened on NNDM. NNDM is another one of my recent winners. And the institutional transfer numbers were absolutely astronomical, 120%. If we go back to RVP was the first stock that I found. That's you guys are tired of me talking about goddamn RVP. But this is my son. This is the first one that I found. And what I saw was that this is no longer the case. At the time, this institutional transfer was 42%. Same thing with GRWG. When I went to GRWG, the hydroponic gardening stock, I found that at $4. Guess what? That institutional transfer number was going up. It's not the case anymore. It's at $50. I found it at $4. So to me, the institutional transfer number, I always want to see hedge funds buying whatever I'm buying.
Okay.
That's just my style.
Okay. One last question from me. When you was talking
Mr. Harris, what do you want me to look at?
Well, hold on. I know you're running short on time, so maybe we can visit this again. But this was sort of like what my question was. I had a stock. The call number is SID SID, right? So it's been doing good for me. That's actually SID. Take the C off. I think you got to see it.
Okay.
SID.
Oh, oh, my fault.
Okay.
Okay, SID. Oh, okay. Man, that's a very bullish chart.
Yeah. So I got in at 3 something. It was like almost less than that. It was $2.85. Now it's up to $6 and something. So I don't know what to really do with it. I'm just messing with it and playing with it. But I'm just saying, when you say wins and losses, are you saying like if you the 1 to 2 to 1 to 3 is, and I'm looking at colors, you saying your wins are as long as you stay in green and don't go red, or you just count how it, like when you get up to say 250 and it goes down a little bit? Is that a loss every time you say if you made $50? Well, if it goes back down to 30, is that considered a loss?
I see what you're saying.
Yeah.
And if you still up in the stock.
Yeah. So I consider a win and a loss. So this is a dangerous way to answer this question. So I want to be careful in my response to you. So I'm going to give you the answer. I'm going to tell you why I'm being careful in my response to you. So the answer that I'm going to give you is, when you won and you lost when you have a realized gain. You buy a stock and you sell a stock. Okay. Realized gains means that you got out of the position. I won because I made money, because I know I made money because I sold the stock and I'm no longer in it. I know I lost money because I sold the stock and I lost money and I'm no longer in it. So here's what idiots say on Reddit and on StockTwits to get around that. They say, I haven't lost because I haven't sold, but they're down 60% on the stock. I'm not a loser yet, and you're not a loser until you sell. So that's why I'm being careful about the way I respond to you.
Okay.
So the official answer from me is, you win when you have realized gains, and it's no longer in your trading account. But that comes with the caveat of you need to cut your losses quickly.
Okay. Actually, well, this I mean, like I said, this was one of to me, this was the strongest stock I ever had, because like I said, I started at 2 something, it went to 4. Now I'm up $350 right now. I mean, I'm just playing with it.
This is gorgeous.
But I mean, so I'm thinking about, okay, and during that little dip, it went down a little bit, but I held in. As a matter of fact, I bought 5 more shares, so I'm up to like 85 shares of it. So I'm just, but like I said, this is just something I'm just watching it. I'm saying, okay, it's been on a steady climb since I bought these things. So, so that's what I was trying to making sure I know win loss. Don't just hold on to it when you see, okay, I done made $400-500. Maybe it's time to sell it, but it ain't never went down really.
I think in your case, you should set a stop limit.
Oh, okay. Well,
So
okay.
But the only thing with that, they don't work in extended hours. So after the market closed,
totally done.
Store, yeah. But as far as he should have a stop limit. So just in case it do break to the downside,
you'd be able to, so it'll sell. Yeah, okay.
Still having a profit. Yeah.
Okay. All right, Aaron. Thanks, man. But I was more or less on that 1 to 3, that, because
right, yeah. Thinking, so once you're in a trade, essentially, I didn't want to talk about evolving R. Evolving R is the fact that as you're, so I can talk about it, which is as your trade gets, it all depends on the structure with it. If you're following the structure, which is entry price, stop price, and target price. If you have a target for your trade, like if I were in your trade, my target would be that line that I just drew on the chart. It'd be $6.35, which is where it's at pretty much right now. The reason why is because this is a significant resistance level on the chart. So you got it at $2, which is incredible. Like you almost got it at the bottom, and then it's been in this crazy uptrend. But I'm on the weekly chart right now, and I'm looking at the previous price action over the course of the past 15 years, and the $6 level on SID has been very significant, and I see it, and I see the price currently reacting at that price. Right. So if I'm you, my risk to reward ratio would have been I've got $2 and I'm betting the bottom at $1, so I'm betting $1 a share, and I'd have looked at this chart, I'd have seen the $6 level. I'm betting $1 a share to win $4 a share. Yeah, because from 2 to 6 is $4, and my loss, I would have sold it at $1. You're up 4x. If I was you and I'm in this trade, I'm taking profits because this is the resistance level. I don't know your thesis on the trade. I'm not a financial advisor. This is
no. I understand. No, this is more of a learning thing. I understand I understand what you're saying, and I was getting close to pulling the gun on it too. I just didn't want to, because everything was going good. Then also, with the effects of what happened a couple of days, it went down a little bit. So I'm saying, okay, this might be it. But then it did right a little bit back up. So like I say, I appreciate the knowledge.
Yes, sir.
Like you and a lot of I have a terrible time knowing when to sell. So what I do a lot of times is if I've made money and I think I made enough money, I will put a stop loss in there to so I can just set it and forget it. So I don't have to really worry about it going up and down. And if it goes up further, that's great. I just raise my stop loss limit a little higher. And if it goes down, it hits that price, and I'll be out of it. And then, hey, I got my money, and I ain't have to fret about it. But I've watched a lot of winners turn into losers, and I've had to learn how to do that myself. I had to pretty much get myself the discipline to do that, because it's like I always explain to people being investing in the stock market. You are one person in real life, just going throughout doing your daily activities, but you're a whole nother person when you got money online.
Right.
Me and Phil was going ham today on Zoom this morning. when Robinhood and Webull and everything else was froze, we were going crazy.
E-Trade was only.
We was up by it was just stupid, and that bit went all the way down. You couldn't even see that. It was ridiculous. But that was with some calls that not necessarily shares. So yeah, Josh, I know you got to go. If there are any other questions, we can possibly do a part 2. If there's any other things that we want to discuss before we, close out, we can. I know DeFazio, Aaron, you guys all have some really good tips too. So if there's other questions on the group that you guys are willing to answer, and they have, Josh, we will relinquish you and let you go do your business, because clearly you double booked.
And yeah, this was good, y'all. I really appreciate it, and I hope you found it valuable.
Absolutely, always.
Appreciate it, Josh.